stock options versus futures options, which one is better, and why you can make 5 times more money with, you guessed it, with futures options and have a much higher probability of profit. And I've been trading futures options for the last 10 years. So I have a pretty good understanding of what works, what doesn't work, and why just essentially futures options are just 10 times better than stock options. So this is going to be a pretty quick video, just highlighting the differences between stock options and futures options. So stock options, they use just normal margin. Unless you have portfolio margin, then the margin requirements are pretty small. And futures, they use something that's called spend margin, right? So because of the spend margin, you can get a pretty big premiums as opposed to stock options. So let me just give you an example. We're looking at natural gas futures options chain. So let's just, for example, let's just go and sell a delta 10 strangle. So this is delta 9.8, and delta 10 on the other side will be, see right over here. So let's see how much margin requirements we have and how much credit you get. So for this position, for one contract, you get $740 in credit, and margin is $1,500, which is unheard of. So you're getting so much credit for such little margin requirements or margin impact. With stock options, to get the same amount of credit with normal like margin without portfolio margin, you will need to probably allocate, I don't know, $30, $40, $50,000 in margin requirements, and this is just $1,500. Now, natural gas is the most efficient, or one of the most efficient products in terms of margin, but most of the products are pretty much about the same thing. A bit more, some are even more efficient. So this is a huge plus, but it's also very easy to over leverage. We'll get to it. Now, the opening hours or the trading hours. So stock options is 9:30 to 4. We all know that. Futures options, they're open basically 24/6. So they're open from Sunday 6 p.m. until Friday 5 p.m. And there's a break between 5 and 6 p.m. every single day. So this is most of the products. Not all of them trade within these hours, but some products like the grains, they trade pretty much all the time. But the break is between 2:20 p.m. and 8 p.m. instead of 5 to 6. That's the only difference. But overall, you can trade it in the evening, at night, early morning, doesn't matter. It doesn't have to be in between 9:30 and 4, which is pretty good, especially for a lot of people that just have day-to-day jobs. This is a huge win, right? Now, the price is driven by hype on stocks, so tweets and whatever not. Price can also move because of fundamentals in the stock, obviously, but it's more likely to move because of hype as opposed to an actual breakthrough in a company, which is really, really hard to trade based upon or based off in my experience. Now, futures options, they're driven by supply and demand balance. That's all. So if something happened to the supply or to the demand, you can really quite easily analyze it and understand exactly what's going on. And like I said, the premiums are pretty big because of spend margin, and they're pretty small on stock options. Now, the multiplier for stock options is 100 by default, and for futures options, it's different pretty much for every single product. And the way you know exactly what multiplier is, you can either see it on the option chain, you can look it up, or the easiest way is to maybe go to TradingView. And these are the only products I trade. There's 7 of them, 7 products. So if you, for example, go for natural gas and you want to know the multiplier, you just go here and go to the contract size. You can see it's 10,000. So the multiplier will be 10,000 for natural gas. If you go to gold, the multiplier is going to be 100 for the option. This is how you can easily and quickly figure out the multiplier for futures options. This is 1,000 for crude oil. Now, because of all of the factors here, it makes stock options trading much lower probability than futures option trading. You can really be much higher probability. You can sell lower deltas because you get enough credit. So you can by default, it makes it a much higher probability kind of trading. And I can attest to it. For the previous 2.5 years, or almost 2.5 years, I've had 3 losses really with futures options, and all of the rest are just wins. And even the losses, they were pretty small marginal losses. All right, so you can really nail it down with futures options, something you cannot do with stock options. And it's all based on leverage, so it's pretty low leverage with stock options and pretty high leverage with futures options. So there is a price, it's high leverage, and if you don't understand the actual risk you're taking, you can easily over leverage, and it doesn't matter that it's high probability or not, you'll end up just blowing your account, which is definitely not something we want. So this is something to kind of take into account, because if you don't, you'll end up blowing your account eventually. This is what usually happens when people migrate from stock options to futures options. The leverage is so high and they don't understand it, so it's really easy to just stack up more contracts, and when things go south, it's gonna be too late, obviously. So that's it for this video. Pretty simple. Hopefully it was pretty good for you guys. It was a request to make this video, so I did it. Again, thank you so much, and I will catch you in the next one.